Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. I'm delighted to be here in New York City, joined by a former guest on the podcast and a long-term colleague and friend and guest on the 50 Faces podcast, Jesus Amadeo. And beside me is John Chesshire of Sindia Capital. Jesus Amadeo is at the MDRC Endowment in New York City. So we are going to cycle through our usual themes and kick this off. So I've called today's podcast Trading Places, as we do seem to be trading places in terms of where we are seeing whether the expectations on interest rates and also some of the fortunes that we're seeing around the world in terms of which economies are benefiting from AI's promise and equally which economies are struggling with the fallout from the current geopolitical flashpoints. So if we look at our usual topics, we'll be speaking about inflation, geopolitics, interest rates, equity markets, and other asset classes, and checking in on general economic vibes. John will be chiming in with his current views across all of these areas, and we'll be calling on Jesus, who is an IT expert and always been an early adopter around AI, to give us his on-the-ground case studies as to what he thinks regarding this current melt up in AI interest, regarding the expectations of AI usage, token usage, and beyond. In terms of the sub-discussion topics, we know that inflation is heating up again. Rates are back on the table for discussion, and it's by no means clear that the next movement is down when it comes to rates. We're going to be looking at stock markets and asking why there has been this phenomenal move, particularly in the picks and shovels part of AI, particularly around semiconductors. And as we speak, we are still dealing with the Instagram moments from the recent trip to China by President Trump and a huge cohort of tech leaders. And we'll speak about whether that may mean some new developments are on the horizon when it comes to trade. And as always, we'll look at portfolio implications. So here are our guests. John to my left, he's at the founder of Sindia Capital Advisors, previously a Clearbrook consulting firm. He's been a two-time guest on this podcast. Jesus to my far left, Senior Vice President at MDRC and Chief Financial Officer of the corporation. Let's start with inflation. So we've just been discussing here in New York City that the experience of inflation in New York City is quite a bit higher than the national level of inflation, which currently has come in higher than expected at over 3%, closer to 4%, in fact. So we are very far away from the target inflation of 2%. We know that the makeup of inflation has been changing from energy representing a large proportion originally, then to services taking the helm. And now, due to the Iran situation, we now have energy and food representing a higher level. And when it comes to inflation expectations, we can see, certainly as expressed here by 5-year break-evens and tips, that inflation expectations have also increased. That is something that was actually specifically addressed by the Fed, that they were concerned about inflation expectations becoming sort of a self-fulfilling prophecy, and that could in fact lead to even more inflation. They've also used the words not misbehaving when it comes to inflation. So I'm just going to put it to John and Jesus here, whether you're seeing this. We're sitting in New York City, an expensive city. Do you think that inflation is now likely to rear its head in a significant fashion again? Or would you put this down to some kind of a blip in terms of the recent spike in oil?
Frankly, I think it's largely as a result of the oil shock, and that has permeated through all the other product categories and inflation categories of the CPI. I mean, even just think about tomatoes, and one of the largest increases in the CPI was tomatoes, and think about what goes into that in terms of transportation, getting them to market. A lot of that is oil. So until this is resolved in the Strait, I don't think we're going to see any significant decline in inflation anytime soon.
And it doesn't bode well for the $1.50 pizza slice if tomatoes are on the rise. So that may be in the rearview mirror, the home of the $1.50 pizza slice here in New York City. And Jesus, can you expand on that? So you mentioned the New York City inflation being higher. You also are responsible for corporate expenses.
Inflation, the CPI for April for New York, New Jersey area was 4.6%. And that it puts pressure on wages. People would like to have higher wages that at least cover inflation. It also, I don't think, even though it's also the inflation is caused primarily by the oil shock in the terms of prices, it will come down not as fast as it went up, because prices are not going to come down as soon as the oil pricing is resolved. Prices don't come down.
No, that's very, very well noted. And I think it also feeds into this. We talked about melt up. Could we see inflation start to melt up itself now? And these expectations come through. This obviously directly relates to bond expectations now. We've had Susan Collins say that a rate hike scenario is on the cards as inflation risks tilt higher. We've also seen short-term yields get to an 11-month high. I had a headline from earlier from the UK, which have its long-term borrowing costs at a 28-year high. So we're certainly seeing a lack of confidence, perhaps at this in the government bonds here. A U-turn potentially ahead in terms of Fed direction. We have a newly minted Fed chair. He may or may not have his own agenda. He may or may not have any freedom to do anything about that agenda. But this would probably chill markets, shouldn't it? If we were to see an end to rate cut expectations and maybe see them go the other way.
Yeah, I mean, frankly, I don't think there's necessarily going to be a cut in the near future, and we will see how inflation takes hold going forward. Whether the straight issue in the strait is resolved or not, that's going to play heavily in terms of whether there's a cut or an increase going forward. Yeah.
Well, there will be robust conversations and discussions at the Fed.
Yeah.
Those will be minuted, and we will get a sense from that. But I don't think there will be any changes in interest rates in the first meeting with the new chair.
And I suppose it's worth talking now about whether we can see a different Fed emerge. I mean, we know we have Jerome Powell staying on as governor, and that will certainly leave a continuity, that will certainly leave a mark. But one of the hallmarks of his Fed under his chairmanship was a lot of telegraphing, it's almost like a hyper communication. And that definitely markets became, I think, used to that level of communication. They were used to a kind of a no surprise policy. It seems that Kevin Warsh is in favor of less communication and maybe a slightly more pull back from the Fed's kind of active role. Do you see, I get the impression that we are all weaned now on a constant supply of data, whether it's meaningful or not. That seems that could also be somewhat, let's see how the first few press conferences go. But I think there could be perhaps investors not being quite satisfied with the level of clarity they get.
I think that it's going to be a whole new dynamic, and it's going to be a much quieter Fed going forward. So yeah, it's something that investors are going to have to adjust to.
Fill in the gaps, I suppose, which could be a lot less certain. The other area we have a lot of gaps seems to be jobs. Since we had our last podcast, we know that we've had a positive jobs number, over 100,000 new jobs. And we've also seen just today Cisco be rewarded for it making job cuts because of AI. We've seen GitHub make those cuts, Coinbase, Nissan, restructuring everywhere. There's also a data point that suggests that these are kind of noise, that they're interesting headlines and it's a great narrative to weave, but that really it doesn't move the needle when you have jobs increasing like this. I think the interesting point here is that in terms of the power of labor, that wages are pretty flat when prices have started to tick up again. So again, the average consumer who is subject to lower end wages will be squeezed if the prices are going up. Do you see that the job market is reflecting the economy and the consumer sentiment on the one hand, which seems poor, or is it reflecting? Is it more aligned with the stock market, which seems to be at new highs?
It's interesting because most of the cuts came in the tech space and the government space, but healthcare workers, education workers continue to. There continues to be job growth there. I don't think it's necessarily permeated through the whole employment sector yet in terms of while we've seen some mixed views on consumer confidence, I don't think it's necessarily been the case with the employment numbers just yet.
I don't think one can generalize from just a few headlines what is going on within the employment market.
Yeah.
What's really going on is going to be dependent on the industry, on the sector. And it's too early to see a trend.
Yeah. Well, that's an excellent point. I mean, I think that is what's coming up from the on the ground experience around AI is that actually it needs more people to implement and to manage at this point, especially at the rollout stage. It hasn't done straightforward substitution. We know that existing employees are busier. And it's difficult I think this is why jobs is such a controversial number, because it's difficult to whether you're looking back, they can be revised, but to see how much of this reflects actual cuts or is simply reallocation of resources. In terms of moving to the equity markets now, well, the story clearly of the week has been the Dow at 50,000 and the earnings on fire, as we're seeing here, new records being hit. It says here the S&P 500 earnings per share usually beats expectations, but not like this. For those listening on audio, it's a pretty, I'd say, a vertical line here up in terms of the Q1 2026 earnings season. So a bumper earnings season, maybe skewed by some of those big tech names that we've seen with their cloud revenue exploding, and that certainly has driven markets. But if we also look across the semiconductors more generally, really quite staggering performance here, which seems that there's just this insatiable demand for compute. And equally, it's not just a US phenomenon. We've seen the chips and picks and shovels elsewhere, and the demand for chips, say from Samsung, seeing a 5x return in the year to date even. So clearly something staggering going on within the semiconductor space. This does feel a bit like a melt up or bubble. Would you share that, or do you think this is borne out in the fundamentals?
I do think that there's some concerns with respect to valuations and a melt up. But with that said, we have seen a broadening out of equity returns. The Mag 7 isn't the entire driver of returns in the S&P 500. If you look at on a year-to-date basis, the 3 or 4 of those names are actually the ones that are of the Mag 7 that are driving returns. The other 3 are in negative territory. We've seen a broadening out of in other areas, energy names, for example, industrial names, continue to help drive that earnings growth that we saw in the previous slide.
And this NVIDIA has done poorly here relative to Tower Semiconductor, ON Semiconductor, and Akamai Technologies, but this is a stock that has just crossed the 5 trillion market cap. And I think we covered it with bated breath when it covered past the 3 trillion market cap not too long ago. So I suppose, what does an equity market look like when it has behemoth stocks that dwarf what we would have thought about as a large market mover?
That's a great question. As you're mentioning that, I think back to the Toronto Stock Exchange when Nortel was 30% of the index, and in the early 2000s, and what happened there. I don't think we're quite in that territory just yet, but there are going to be some names that are clearly going to dominate, and we'll see what happens later on in the year if there's any change in or more concern about those valuations. But yeah, there is certainly some concentration in the market for sure.
But I think what is interesting here is the chart on the right, the age of ChatGPT, the market's view of who will profit most from AI has turned around. So this is plotting the SOX, the semiconductor index, relative to Bloomberg Magnificent 7. So we talked about rotations in the past, and we traditionally think of rotations as almost full rotations out of, say, tech into something more defensive, maybe into healthcare or financials. But even within AI, there is now a rotation out of the Mag 7, which maybe led the charge. We know that they are cash rich. We know that they spent a lot. We're following the money, essentially. What are they spending it on? It's already shifted into the picks and shovels. We know there are other ways to play the picks and shovels too. It could be data centers, it could be infrastructure funds. But clearly this has been an immediate source of following the money. And probably there's less concern about CapEx spend and its pressure on the balance sheet if you're the recipient of that CapEx spend, which is the state of the semiconductors. Are there any, I don't know that sector well enough in detail to know about the constraints that they may face, the semiconductors, the semiconductor companies themselves. Do you see that they will be supply constrained in turn?
I don't know the exact situation on the current supply, so I would not be able to say anything that would be insightful. I mean, historically, the supply have had a tremendous effect on their ability to not only produce, quality control, and other factors.
Yeah.
But I don't have a full understanding of the current constraints.
Well, I doubt your average stock market investor does either. I would suggest that the volume of flow into these stocks has probably taken place based on a lot of forward contracts, which have tremendous uncertainty built into them. And if you've listened to any of the recent, there've been a spate of long form podcasts with senior levels executives within, say, Anthropic, and they mention the fact that core to their agreements that they stack up is a tremendous amount of flexibility, because they themselves are trying to prepay for at least secure compute with a large flexibility component because they don't know how that compute will actually end up be needed or in what way, or whether efficiency will dictate they don't need quite as much, or whether demand will dictate they don't need as much. So I think that massive flexibility like that is very difficult to model. So it would suggest that the demand for these stocks has not necessarily gone through that rigorous process. Now getting to another source of rotation and also topic when it comes to the stock market is US exceptionalism. We're sitting here in the grounds of an investor foundation that has always had a global approach to investing. And that I'd say reflects most in foundations and institutions in the US as well as around the world. But the US exceptionalism, I think the bell keeps ringing on this. And there was a suggestion that we'd seen it recede. And now it seems to be back again in terms of the multiple relative to the rest of the world being still being high, but being justified because of this strong underpinning. And it is historically expensive based on the cyclically adjusted price earnings ratio. But again, there would be a suggestion that this, because these earnings are so robust, that this is actually being justified. So I suppose I sit in Europe and I have a few slides later showing that things aren't actually that bad outside the US, but the narrative certainly seems to have taken hold. And I think there was an interesting counterpoint here by Mohammed El-Arian in the Financial Times. He suggested the US decoupling from the global gloom has limits. And he's acknowledging that the US has taken its own path, but that does not, we are still interconnected and we are still dependent on trade. We are still dependent on our trading partners for demand as well as for parts. So whether, I suppose the question here, is there a global gloom? That might be a big presumption, but equally whether the US can exist as an island that is distinct from that.
I disagree. I mean, I think that we need international trade, and to the extent that markets are undervalued offshore, I think that's an opportunity. The managers that we deal with candidly have started to take increase their positions globally or outside of the US. And yeah, I mean, there are some certainly good values. I think that maybe they don't necessarily have the tech exposure that the US has, and that clearly is what's driving the US markets at the moment for the most part. But there are good values offshore.
And I think based on the idea of following the money, if we are if the US has almost become a new economy stock market, whereas many of the other stock markets, I was just in Australia, very classically old economy, financials, mining, FTSE, classic old economy. So none of these have been hot tickets, but they're also, the old economy is called the old economy because it's still there. So these kind of steady state as the building blocks of the economy are still in demand. We know that energy will still massively be in demand. Mining, especially since of copper, massively in demand. So I would suggest that these old economy may not be getting headlines, but they are also quite an important part of the global economy. And equally, if we're looking at we're talking about the next leg down, perhaps, or leg up in terms of AI adoption. If it comes, we're talking the US in the mid-cap segment, shouldn't there be big swathes of companies in Asia and in Europe that are also poised to unlock their own productivity gains through AI? So I think to write off does seem to be. It seems like you would agree maybe with the headline here then, that the decoupling it cannot continue.
Correct.
Yeah.
Yep.
And I think that when we mentioned this tech trend being global, this is some slides here from China, speaking about China's unbalanced recovery, which it is showing that the consumer, it was always about the China consumer. For years, it was always about this consumer that was poised to start to consume and to really take their place with other world consumers. And it was the consumer durable stocks and discretionary stocks that were actually in demand. Here we can see that China has become almost a mirror image, well, actually a carbon copy, should I say, of the US in terms of infotech dominating there, as well as materials, the underlying source, and the consumer has actually been quite flat. So that I think is an interesting kind of turn up of the Chinese picture, and that we're still doing very well, for example, in the Shanghai Shenzhen CSI 300 index. So definitely a tech trend has captured the imagination out east. we have some highlights here of the delegation that went to, again, all within Air Force One by the looks of things. Elon Musk, Jensen Huang, and Trump, as well as a number of other of his high level officials in China for quite I'd say some interesting diplomatic theater. Probably we had analysis of the handshake, analysis of the parade, analysis of some of the gestures, and a lot of even analysis of the menu and of the music choices, from what I can see. So clearly a very exciting moment in terms of the next stage for these two competitors. And I think should not be overlooked, that I found an interesting chart here showing just the change of market share that some of the industries in China have taken in terms of their share on the global stage. Just look at maritime engineering, railway construction, robotics. They're massive growth in share taken by China. And this was a point we made in our Singapore podcast recently, that China has become, it's no longer a sleeping giant. It is a giant that is working through the night to accelerate in all of these areas. And if this pace continues, there will be an absolute dominance in terms of these critical segments as we go. And I think we know that China held a certain number of cards at this Beijing summit. I suppose the question for me is whether we had a little bit of a flashback of a tariff announcement with the tariff on European autos recently. But tariffs have very much been in the background as we've spoken about Iran. It seems like there hasn't been much movement in Strait of Hormuz this week. So we're back to talking about tariffs again. Do you see that the tariff, I suppose, element of surprise has still the ability to shock markets, or do you think we're done with that?
I think we're a bit done with it. I mean, I think that we're waiting to hear on how some of these tariff issues are going to be resolved within the U.S. and within the courts. So any new publication, I think, or discussion of them, I think it's sort of a wait and see. But what I will say is a lot of these market share charts are a result of some of the tariffs. And while the U.S. has been assessing tariffs on other nations, it's given China an opportunity to go and form relationships that they may not have otherwise had previous to the tariffs. And we're starting to see green shoots in some of these areas as a result.
And I think it's an interesting point, because just to go back here to the Chinese chart, not so long ago, we were talking about China being uninvestable. And there was a sense that maybe emerging markets ex-China was the best way to gain exposure. There was a sense that perhaps regulatory overreach was going to be ultimately destroying shareholder value, and that the rule of law was not being implemented. We're concerned about democracy. And it seems that investors just turn their back on China. But my sense is that narrative has completely dried up at the moment. We're back to thinking of China as a pro-growth, a pro-commerce, and clearly very much on the cutting edge of advancement. And that seems to be somewhere that investors would want to get exposure. And I'm not sure, it's a very interesting change of narrative, which suggests that some of these things are very emotional driven and not necessarily driven on fundamentals.
I think that's exactly right. And that very well may be the case with what we're seeing in the U.S. markets too, and the exuberance you mentioned in the melt up.
Yeah.
Some of that may be emotion driven.
Well, equally, I don't think I have the chart regarding Korea here, but we have at least the headline regarding Samsung Electronics, and Korea maybe is a proxy for the growth in China, it certainly has seen staggering. We saw it went limit up, I think, on Monday. So clearly there's been a desire to rotate in there. And I think we shouldn't forget who could be driving these flows as well. I mean, we've talked about whether there's been a flight out of US assets in the aftermath of both Liberation Day a long time ago, ongoing trade tension, and now also the Iran war. But there's clearly cash on the sidelines that is looking to deploy elsewhere rather than in the US. So I think an interesting phenomenon there. The last slide I have today is on Europe. And there are two real points here. One is that it continues to be the case that America's war is Europe's problem. We still have Europe showing more volatility, far above US volatility since the war started. It's interesting because Europe has actually been dragged into being involved in this war very reluctantly. They're certainly not actively involved, but they are involved by virtue of their dependence on the oil flowing from there. So there's maybe this passive stance has been punished because it's nothing but pain. there's no upside to them for the situation. They have no control either, nor can they control the outcome. And equally, this is a little bit older, but this chart that the views on the Straits had driven a negative performance by European stocks, positive performance by US stocks. So Europe wasn't in a great place to start with in terms of coming into this this summer, but it certainly doesn't seem to be the beneficiary of much good news. But I thought there was some interesting kind of hidden gems here in that we are within Europe. As I said, it cannot be the case that there is no AI play in Europe. It's a huge population. There are some incredible educational institutions. And we've heard a little bit about my base in London, Anthropic having their global headquarters there. And there's certainly room for improvement in terms of the venture capital ecosystem there. We are not starting from a frothy, saturated base. So whether these are just some particular stocks in terms of share prices within AI, hidden Soltech, Calray and Riber as some mid and micro cap names in Europe, according to the London Stock Exchange, and then seeing the AI plays have been leading among European stocks in 2026, well-known names such as STM Microelectronics, Nokia, BE Semiconductors. So a similar pattern appearing when we see the year-to-date performance. I'll say Extron at over 100, looks like 170% here. So it's not being left behind. It's probably just not getting much attention.
Agree.
Yes.
Yeah.
I agree.
So that's the end of our prepared remarks here. We've tried to stay away from private credit over the course of this discussion. I think it's we've pretty much there's nothing new to report. The headlines of the week have basically circulated around the equity market movement, so some saber rattling on trade from China and the US, and we've had relatively little developments in terms of the war, but I think a relatively strong start to the week in terms of the employment numbers we saw at the end of last week, and the good times, may they continue to roll. So thank you so much, John and Jesus, for joining me here today. And thank you for listening to the Markets Happy Hour podcast.